Hey guys, welcome to another Trade Genius podcast. Bob and Phil here as always, and we wanted to follow up from Saturday's video on that warning we issued, and we wanted to dive a little deeper into the mechanics of the volatility that we're dealing with, the volatility index, how the option traders are really leveraging up, and also we want to take a closer look at the yield curve inversion and just show you how dangerous things are going forward from here. You're not going to want to miss this one, so let's dive in.
Trade Genius.
Hey guys, also too, please hit like and subscribe and ring that notification bell to stay abreast of all the breaking financial news that we come across that will help you and your portfolio. So first thing we wanted to do is jump into this yield curve inversion chart. And Bob, tell us a little bit about what's going on here.
Yeah, look, there is, I guess, a narrative being positioned right now on social media that a new bull market is beginning. And if that is true, it'll be the first time in economic history that the physics of the stock market is going to defy reality. And this is primarily because what the Fed is doing is creating an environment that creates a recession 100% of the time. And I don't know about you, Phil, but I don't remember stock markets going up going into recession. Can you recall one?
No.
Yeah. So whatever you're seeing in the stock market here over the last 5 days is, and I had a chart too. I must have got lost in the stuff I was sending over to Phil, but we've had one of the largest and most persistent short covering rallies that we've had in a long time. And so whatever you're watching now is a drowning man trying to get more oxygen, and he's trying to bring the lifeguards down with him when he drowns. So I'm just warning you guys out. We're not talking a week or two out here. We're saying in 2023 we're going to run ourselves into some issues. And Phil, I think you have a chart showing this in a different way. You want to throw that up and talk about it?
Yeah. So on this chart here, you'll notice to Bob's point that we're overbought, and this lower chart section here is basically how we measure breadth. And you'll notice that breadth, we tend to get a little cautious when we get into these areas because they tend to produce larger moves down. And the exception to this would probably be back in August when we saw this persistently overbought on breadth, and it did actually hold for a while, but finally it rolled over. So you do run into these situations where the market stays a little pinned, but even if that does happen, you tend to get a very severe correction afterwards. So if you don't get the immediate reactions similar to what you see over here, you could possibly get one of these situations. But we also take a look at something else called the liquidity, and that's this blue area. And so if it's falling off, so this gets overbought and you can see liquidity starting to trend down, that gives us more clues as to the potential rollover there. So in this area, liquidity kind of held up, and so it stayed a little longer. You can see when liquidity started to drop off, the market's weakened significantly, and then liquidity really dropped off and the market followed. So this Fed liquidity is really what drives the market. So we look at things like the market breadth to kind of clue us in between that and the liquidity to give us a better idea of where we're at. But whenever we get this situation here that we're overbought like that, definitely a warning sign on top of the other stuff that we've been looking at. So the other chart too we wanted to get into was, before we move into the volatility stuff, is the yield curve inversion. And here you can see where we're at. I mean, we're more inverted than we were back in the great financial crisis and the tech bubble. So this is a significant area right now. And I've highlighted, basically, this is a weekly chart, and I've highlighted how many bars it takes by the time, so that's 99 weeks essentially, or 100 weeks back in the tech bubble, 103 weeks. But essentially what that's doing is that's looking at where the yield curve inversion stopped and then started running back up. And it's that running back up that's really the worst part of the bear cycle. And we basically just transposed what that would look like here if we were to start to turn up from here. For one thing, if you went out like 100 weeks, that takes us all the way out to December of 2024. Okay, that's far longer than anyone's really expecting here. That also gives us this, we actually threw on a projection here of what a bear market waterfall would look like, similar to what we've seen in the past. We haven't had this part of the bear cycle yet that rolls over quite sharply. We've had a few ups and downs, but we're expecting that we might see this happen, and that does happen, you could see that in the grand scheme of things, breaking through 3,000 on the S&P 500 isn't that big of a task for a bear market. So this is something you definitely have to key in on, something we'll update regularly on this channel. But the point is that we're at a point where the yield curve is very inverted. It's going to normalize, and that normalizing process is very bearish for the markets, no matter what you're hearing. And like Bob said, unless the laws of physics are broken here, we're going to see exactly this happen. And you just need to be aware and protect your portfolios going forward. And then, Bob, you wanted to talk about the zero DTE leverage. So let's dive into that. And that is this chart here.
Yes. So, Phil, we know that what moves the markets really is Fed liquidity, derivatives, and cash flows, right? And so cash flows have not been participating in this environment. In fact, they're starting to drift down. Is that and Fed liquidity has been drifting down. So why is the market going higher? The market's going higher because traders now are using the options markets to basically manipulate dealers into doing trades that lifts the equity markets. That can work in reverse too. And so the way it works here in the options market is if I go ahead and I buy calls on Tesla, okay? The dealer is selling me calls on Tesla, and to protect himself or herself is that he's buying shares of Tesla. So I force him or her to drive in the same direction as I am. And so if you guys remember Wall Street Bets last year, or 2021, I think it was, when they were just driving the market, SoftBank was out there, and they were making things look like happy days are here again. Well, they do it with leverage, and they do it with the option contracts. Well, they've taken it to a whole new level, and this is why I call it the drowning man theory here, is because they're hitting walls now, and now what they have to do to push the stock market up every day is that we have these options now that are expiring every day. And so if you can put enough call contracts on at certain points in the day, and you're increasing them every day, you're forcing the dealers to go long the markets with you. And you're creating a what they call a squeeze. Everybody knows a squeeze, but now these are happening with greater frequency and greater intensity. And if you can see that chart, look at the movement in the zero DTE, which means 0 days to expiration, is happening. And this is not good, guys. This is not good at all. Is that if you have one day where this number goes down, the dealers are then, they're not forced to buy anymore. And guess what they do? They sell, or they close their positions, and you get a cascade the other way. And I want to just bring that to everybody's attention here. And this is a big issue. And for those people who are thinking that the Fed's just going to give up here, the Fed knows now, if you're watching the markets, prices are elevated on assets, but sales are dropping for those assets, which means that there's a disconnect between buyers and sellers. And time is not on the seller's hands because what's called the cost of carry. So even if the Fed stops raising rates and he holds for a year, okay, at 4.5%, 5%, that is like corrosion on somebody who's holding assets to try to sell, because they're paying a carrying cost for that, if you will. And that causes them to then start to give up, or they get forced to give up. And then prices are going to come down to meet that price. Powell is still trying to find the trigger number, okay? And especially if they can't get energy under control, and if they can't get food prices under control, that he's going to keep pushing this thing until he gets that momentum shift down, because their view is that they can race down with it. So I just wanted to bring that to your attention. I don't know. Yeah, we have another chart after this, Phil. So that's zero DTE. So the next chart I want to show you is the VIX. So this is another game that gets played. So if I'm a risk manager at a fund, the amount of volatility that goes on, meaning the day-to-day movement in the stock, and also the VIX measures calls and puts that are out of the money looking out 30 days. And so if you can manipulate the volatility to make things, excuse me, make things more quiet, less volatile, if you will, risk managers are allowed to take on more risk. So a game that gets played is you call suppression of volatility. And so if you can see here, look at this move. It's a chart we have up here. Phil and I look at linear regression from 2.3 standard deviations from norm. And to us, that, and we have a long look back period. We look back 144 periods. Is that we know we have high probability trades when it breaks the top of that range or before it breaks into the bottom of the range. Well, they just drove this thing down, Phil, over the last, 5 or 10 days,
Yep.
from the top of that channel to the bottom of that channel. Okay, that should be a warning flag for you. VIX is down at 18. They've had a hard time. It's been lower before, but it's not been going up when it goes up. So we pushed the bottom of the channel. And so then I went ahead and I checked out, looking into the future, I checked out the options markets, and lo and behold, we have options are being bought out now for VIX going into the 15th of February. And so those are alarm bells for me. And so I just wanted to kind of bring that to people's attention. Now, does that mean the market can't push up into the Fed meeting? Well, we've seen that happen before. But what I'm telling you is that if market keeps moving higher, it is a gift for you to trim and get positioned short, because it'll be a pretty nasty February.
Yeah, so I think there's a lot of warning signs here, and I think the complacency level too in everywhere that I see on Twitter and things like that, things are getting very complacent again, and I just think it's a very tricky spot, and I think the big risk down, I think, from here, given just all the internals and what they're telling us. So
yeah, I'd be careful. Look, if the Twitterverse and FinTech and CNBC are telling you things are looking good, they're trying to sell to you. And you need to be careful and cautious. Okay. My only exception is that I think there's a transition going to energy and into commodities and away from tech. So, but we've seen it happen where they kind of dump everything before the new regime takes hold. So just be really careful out there.
Yep, I agree. And like Bob said, things can still go higher. For example, if this chart goes up more, if we see the liquidity start grinding higher and higher, then the Fed's really not that serious at this point in time in pushing this market down. So, you got to be open to that. But there are a few things here, at least in the short term, giving us some pretty decent warning signals. And I think once we start breaking down back below 3,800 on the S&P 500, I think that's where you have to really start looking at, like, okay, we could be making a run for new lows here. So just keep that in mind as we're going forward. All right, guys, well, that's going to do it for this edition of the Trade Genius podcast. Thanks for watching. Please hit like and subscribe and ring that notification bell. It really helps us out. And we'll see you on the next episode. Take care.
Trade Genius.